Welcome to today's webinar, everyone, on advanced head and shoulders pattern strategies for consistent profits, where we will delve into the complexities of head and shoulders patterns. My name is Ali Mortazavi, and I'm the head of education at Errante. Today, I will guide you through one of the most well-known and powerful chart patterns in technical analysis. Whether you're a seasoned trader or someone looking to enhance your trading strategy, understanding these patterns will be crucial for making informed decisions in the financial markets. The head and shoulders pattern is not just a tool for spotting reversals, it can be a cornerstone of your trading strategy when understood and applied correctly. Uh, Throughout this session, we will explore the intricacies of this pattern, discuss the psychological factors behind it, and look at various advanced strategies that can be employed to optimize your trading outcome. By the end of this webinar, you should have a comprehensive understanding of how to identify and trade head and shoulders patterns effectively, even in the most challenging market conditions. So let's embark on this educational journey together. And I encourage you to ask questions and participate actively to make the most of this learning opportunity. Thank you. It was to mention that this webinar is brought to you by Errante, which is an online broker committed to providing top-tier services and building lasting and trusting relationships with clients and partners. Before we begin, please note that the content of this webinar should not be construed as investment advice of any kind. The strategies and information provided are for educational purposes only and should not be considered as a recommendation to trade. Thank you. And here you can see our risk disclaimer. Okay, so let's get through our agenda for today. In this webinar, we have structured our learning path into 5 key segments, each designed to build on the previous one, taking you from a foundational understanding to advanced strategic application of head and shoulders pattern. First, identifying the head and shoulders pattern, we will begin by laying the groundwork with the fundamental techniques. You need to accurately identify head and shoulders pattern. Recognizing this pattern early can give you a significant edge in predicting market reversals. Then, moving beyond the basics, we will explore more intricate variations of the head and shoulders pattern. These complex structures often appear in multi-time frame analysis and can provide deeper insights into market behavior. This session will help you distinguish between simple and, let's say, composite patterns, enhancing your analytical skills. Once you are familiar with identifying the patterns, we'll shift our focus to actionable strategies. At the end of introducing each pattern, you will learn how to effectively trade the head and shoulders in the context of the market, including entry and exit points, risk management, and optimizing your trades for maximum profitability. The head and shoulders pattern isn't just limited to a reversal pattern. In the next section, as inverse and continuation patterns, we will discuss its inverse form and other continuation patterns, expanding your toolkit and enabling you to apply these strategies across different market scenarios. Finally, we will conclude with an interactive Q&A session. This is your opportunity to ask any lingering question and share your thoughts and to engage in discussion. Our goal is to ensure you leave this webinar with a clear and confident understanding on how to incorporate these advanced patterns into your trading practice. So I encourage you to participate actively throughout this session, ask questions, take notes, and think about how you can apply these concepts to your own trading strategy. So without any further ado, let's dive into the world of advanced head and shoulders patterns and start refining your approach to the markets. Thank you. Okay, let's dive into the head and shoulders pattern, which is widely regarded as one of the most reliable signals indicating the end of an uptrend. Here we will look at key aspects you need to focus on when identifying and trading these powerful reversal patterns. The first thing is going through the identification rules. Okay, the first thing you need to observe is the presence of a preceding uptrend. Without this initial trend, the head and shoulders pattern loses its significance as a reversal signal. Okay, next you will look for the formation of three peaks: the left shoulder, the head, and the right shoulder. The head should be the highest point, with the right shoulder forming a lower high indicating weakening momentum. And the pattern is not complete and actionable once the price breaks through the neckline, which is the most important part here. Uh, the neckline plays a role as a support level drawn through the lows created by the left shoulder and the right shoulder. So this is the rules to identify the head and shoulders patterns. It's not really hard. Yeah, it just needs some practice. However, let's discuss how to trade uh, head and shoulders. The ideal time to enter a trade is when the price breaks below the neckline, and this break indicates that the buyers have lost control and the downtrend is likely to begin. And then to protect your position, place a stop loss order just above the peak of the right shoulder, somewhere uh, here. And this ensures that if the pattern fails and the price reverses upward, your losses are minimized, because here a breaking above this level would be the first sign that can trigger the invalidation scenario for this head and shoulder. And by the way, a conservative approach to take profit is to aim for a risk to reward ratio of 2 to 1 or 1.5 to 1. And this means if your stop loss is set at 50 pips, your target should be 100 or 75 pips respectively. For example, then you need to measure the distance from your entry, which is the neckline, and then you can just project your target by extending the line below the neckline here. And the classic, let's say, there is a classic target projection for head and shoulders, which is uh, uh, done by measuring the length of the distance from the neckline to the head and then project it below the neckline from the breaking point. So that would give up another target, and this is something like something more than a 1-to-1 reward to risk ratio, and that would be something you can do, by the way, but it mostly depends on your risk management strategies. But here we have some key points. The reliability of the head and shoulders pattern increases when the depth of the right shoulder, deep shoulder, suggests a more significant reversal. The pattern becomes more meaningful, let's say, the longer it takes to form. So a pattern that develops over weeks or months is typically more reliable than one that forms over a few days. And another tip here is that volume also plays a crucial role in stock trading. A breakout accompanied by high volume adds validity to the pattern, suggesting a strong selling pressure. Finally, practically, uh, let's say, a strong signal is when the right shoulder break is confirmed by the price, uh, let's say, crossing below a moving average and the RSI or relative strength index dropping below 50. And this convergence of indicators add further confirmation that the trend reversal is underway. So understanding these nuances is key to effectively trading the head and shoulders pattern. It's not just about recognizing the shape, it's about interpreting the context and acting with a strategy that maximizes your chances of success. If I want to show you some examples, you can go through the chart and find some good patterns. On lower time frames usually have more chances to find a good reliable pattern. Okay, let's move to something like Euro USD on the 5-minute chart, let's say. And don't forget that it's possible to find head and shoulders pattern on any time frame. It doesn't matter what is your trading style. As long as you are looking for good reversal patterns, you will be able to find the head and shoulders. For example, here it's worth looking for. Here you see we have the left shoulder here, and then we have the head, and then we have the right shoulder. And we can draw the neckline by connecting these two low from the shoulders. And now this is going to be our breaking candlestick with price falling below this low. So this is a very nice head and shoulder pattern. You see a particularly strong signal is generated here when the right shoulder break is confirmed by the price crossing below a moving average and the RSI dropping below 50. If you look at the RSI here, and also we have a cross of MACD crossover below the zero, and this convergence of indicators adds further confirmation that the trend reversal is underway. So this is a good reversal pattern here on the Euro USD chart. Now moving forward from the standard head and shoulders pattern, we now delve into the more, let's say, intricate territory of complex head and shoulders patterns. These formations add layers of complexity, and when correctly identified, can provide even more reliable signals than the standard pattern because of the length and the depth of the pattern. Okay, the complex head and shoulders is characterized by the presence of multiple shoulders or heads within the same structure. Unlike the simpler version where there is only one left shoulder, for example, one head and one right shoulder, the complex version may feature several peaks and collectively form one or more of these components. So these patterns often appear more clearly on higher time frames. The reason is that on lower time frames, the complexity might make the pattern appear less distinct, but as you zoom out, the overall structure becomes easier to somehow discern. So as a rule of thumb, similar to the basic pattern, you start with the requirement of an initial uptrend. Uh, Guys, mm, um, please keep in mind that the presence of an initial trend is the most essential factor or feature for having or recognizing a proper head and shoulders pattern, because this sets the stage for the potential reversal. This is a reversal pattern, and we're going to look for a price reversal to the downside. So the presence of the prior uptrend is essential. Next, instead of looking for a single peak formation, the head, you observe multiple peaks that collectively rise above the shoulders. And this multiplicity can sometimes make the pattern seem messy or confusing, but it's crucial to identify the general symmetry and the sequential highs and lows, something like what you are seeing here. For example, we have a 1, 2, and 3 tops that are almost at the same level with this very long upper shadow here. And now uh, it gives us the opportunity to define this area as the highest level that the price could reach. So the confirmation comes when you identify the final shoulders that follow the highest peak, the head, and these shoulders often appear as a series of declining peaks, indicating the weakening of the upward momentum even in the short term. So here you see we have the right shoulder almost at the not at the same level of the head, but a bit uh, lower than the head, but it's followed by some lower peaks. So these are the features of identifying a right complex head and shoulder pattern. And now let's see how to trade a complex head and shoulders pattern. Uh, As with the standard pattern, the entry signal is triggered when the price decisively breaks below the neckline. Given the pattern's complexity, this break is usually more significant and may involve higher trading volumes. Your stop loss should be placed above the highest peak of the last right shoulder. And this positioning helps protect against potential false breakouts that could occur due to the pattern's complexity. Somewhere like here, maybe at the first, let's say, top your or shoulder top somewhere here, or this one depends on your risk management. But the tighter the stop loss is not always the better, because you need to consider the market volatility because before you set your stop loss level properly. Because when you see the market is very volatile, it's better to give some space to your trade and put your stop loss maybe on the higher top of the right shoulder. So your stop loss should be placed above the highest peak of the last right shoulder, somewhere here or here. This positioning helps protect against potential false breakouts that could occur due to the pattern's complexity. And now let's talk about the take profit strategy. As with a simpler pattern and for a risk to reward ratio of 2 to 1 or 1 to 1 even, this conservative approach ensures that your trades are balanced between potential risk and reward. And this is the most important aspect of risk management, because we need the balance. I know some, let's say, aggressive traders are going to a 5 to 1 reward to risk ratio, and that's your choice, of course. But here I'm just suggesting a very conservative but proper risk to reward ratio, and something that you can expect from a valid head and shoulders pattern. And here are some key points to mention. Again, the depth And a structure of the shoulders play a critical role in the reliability of the pattern. The deeper and more symmetrical the shoulders, the stronger the signal. Then the duration of the pattern also adds weight to its significance. A complex pattern that develops over more extended periods is generally more reliable than one that forms quickly. And volume is another critical factor. A breakout from a complex head and shoulders pattern, especially one confirmed by a surge in trading volume, is typically a strong indicator of a new trend direction. Finally, a particularly powerful confirmation of the pattern validity occurs when the price, after breaking the neckline, also crosses below key moving averages and the RSI dips below 50. This is a very, very good confirmation. This confluence on indicators provides additional confidence in the trade setup. So by, let's say, by mastering the recognition and trading of complex head and shoulders pattern, you can significantly enhance your ability to anticipate and capitalize on market reversals. And these patterns, while more challenging to spot, offer a higher degree of accuracy when properly identified and traded. So if everything is clear for everyone, I'm going to move on to the next slide. Okay, cool. So in this section, we'll discuss a critical topic that many traders overlook: identifying an invalid head and shoulders. It's crucial to understand that not every structure resembling a head and shoulders pattern will function as a reliable reversal signal. Okay, so misidentifying these patterns can lead to poor trading decision, let's say unnecessary losses. First, let's define the invalid head and shoulder pattern. It often arises when the market forms what appears to be multiple shoulders or heads, but the overall structure fails to align with the rules of a valid head and shoulder pattern. This slide shows an example where the pattern might look correct at first glance, but does not meet the necessary criteria to be considered reliable. Uh, to make a better understanding, we need to put some ground rules. Yeah. One of the first signs that a head and shoulders pattern may be invalid is the presence of a weak initial trend for pattern. Yeah, for a pattern to be valid, it should follow a strong uptrend. So if the preceding trend is weak or inconsistent, the likelihood of a successful reversal diminishes significantly. Uh, Next is in a valid pattern, the shoulders, both left and right, should confirm the weakening trend. However, in invalid patterns, you often see shoulders that do not align properly or that show inconsistent highs, which leads to uncertainty about the pattern's reliability. And of course, uh, one of the most important things to consider is that can give us a proof about the invalidity of the pattern. A significant indicator of an invalid pattern is when the price action breaks above the peak of the right shoulder after the initial neckline breach. And this behavior is a strong sign that the reversal pattern has failed and the trend may continue upward, leading to false signal for short trade. Additionally, when other technical indicators or oscillators such as the RSI or MACD fail to confirm the expected reversal, this is another red flag. For instance, if the RSI does not dip below 50 or the MACD does not show a bearish crossover, the pattern should be treated with skepticism. Okay, now it's important to distinguish between an invalid pattern and a less reliable one because they're totally different. Okay, a less reliable head and shoulders pattern may still show the classic head and shoulders structure with weaker confirmation signals, such as a lower volume for stocks on the breakout, or less pronounced shoulders, uh, or the let's say the weaker initial trend. In contrast, an invalid pattern fails to meet the fundamental criteria of a head and shoulders pattern, such as the uh, integrity of the neckline or the failure of the right shoulder. So, common mistakes traders make include forcing the interpretation of price action into a head and shoulders pattern when the underlying structure is flawed. This often happens when traders are overly eager to predict a market reversal and ignore the necessary criteria that validate the pattern. So let's now take a closer look at the chart example here. Uh, at first glance, it appears that we have a classic head and shoulders pattern. Yeah, there's a left shoulder. Let's say this is a uh, head and the right shoulder. However, upon deeper inspection, several key factors suggest this pattern is actually invalid. Let's start with a weak initial trend. Notice the trend preceding this supposed head and shoulders formation. While there is an uptrend, it lacks the strong decisive movement typically required to establish a reliable reversal pattern. The price action leading up to the left shoulder is choppy and lacks momentum, which is the first sign that this setup might not be trustworthy, as you see. And now observe the shoulders, particularly the left shoulder is formed by a series of small irregular peaks that do not convincingly indicate a weakening trend. Instead, they reflect indecision in the market, which is not what we want to see in a valid head and shoulders pattern. And the right shoulder, although more pronounced, also exhibits some issues. The price does not convincingly stable at the neckline after the initial breach. Instead, it quickly retraces and moves above the peak of the right shoulder. And this is a critical sign that the pattern is invalid, as the price should ideally continue downwards once the neckline is broken, not going or not reversing to the upside. So here we can see the signs, and let's move to the other one. Look at the RSI here, yeah, at the bottom of the chart. You will see that even as the pattern forms, the RSI fails to dip significantly below 50 because it's been somehow in selling area. And you will see that even as the pattern forms, the RSI fails to dip significantly below 50, which would typically indicate bearish momentum. This lack of confirmation from the RSI is another clue that the expected downtrend might not materialize. And furthermore, the MACD at the bottom also does not show a strong bearish crossover here. We see a many short bars. The histogram bars remain relatively small, and the MACD lines do not diverge sharply in a bearish direction, further invalidating the pattern. So a key moment to note is when the price breaks above the peak of the right shoulder, somewhere right here, because uh, even if we consider it as a complex head and shoulders pattern, we expect the right shoulder to form lower tops, but not, let's say, somehow uh, piercing the preceding top. So uh, this false breakout is a classic example of why it's crucial to wait for clear confirmations before committing to a trade based on a head and shoulders pattern. So in summary, this chart highlights why it's essential to critically evaluate all aspects of the potential head and shoulders pattern by identifying the weak initial trend, the inconsistent shoulders, and the lack of confirmation from other indicators. You can conclude that this pattern is invalid. Okay, this recognition is key to avoiding false signals and making more informed trading decisions. And here, let's explore the inverse head and shoulders pattern, a powerful and reliable reversal pattern that signals the end of a downtrend and the potential start of a new upward movement. This pattern is essentially the opposite of the classic head and shoulders pattern, and understanding how to identify and trade it can be incredibly valuable for spotting bullish reversal. Okay, let's begin from here that the inverse head and shoulders pattern as you see on this slide, much like his counterpart, is composed of three distinct, let's say, bottoms, with the middle one, the head, being the lowest. So this formation is crucial because it indicates a weakening downtrend and the increasing possibility of a reversal. This pattern typically forms after a significant downtrend, making it an essential tool for traders looking to capitalize on market bottoms. Now let's discuss some rules that we need for identifying the inverse head and shoulders pattern. First, the first requirement for this pattern is preceding downtrend. Without a strong downtrend movement, a downward movement, the pattern lacks the context needed to signal a potential reversal. Okay, so this is the first. The next one, the head should be the lowest point of the pattern, showing the last strong push by the bears before uh, they lose control. And the left and right shoulders, as you see, should form at higher levels, indicating that the selling pressure is easing. Then the pattern is only actionable once the price breaks above the neckline, which is the rule of thumb, which is drawn through the highs of the left and right shoulders. And this break is a key signal that the buyers are gaining strength and the downtrend is likely over. Because as soon as you have a penetration above the last top, it is questioning the prior downtrend. Yep. Now, again, here are some tips on how to trade this inverse head and shoulders pattern. The optimal time to enter a trade is when the price breaks above the neckline, okay? And this bridge signals a shift in market sentiment where buyers have taken control and an upward trend is expected to follow. To manage risk, place your stop loss orders below the low of the right shoulder. This placement is strategic because if the price falls below this point, uh, it could indicate that the reversal is failed and the downtrend may resume. Similar to the standard head and shoulder that we discussed, risk to reward ratio mostly depends on your risk management strategy and rules, but 2 to 1 or 1.5 to 1 is recommended because this means that for every dollar you risk, your target should be 2 or $1.5 in profit. So that would be a very conservative and good way to measure your target projections. Again, the depth of the shoulders plays a significant role in the reliability of the pattern. Deeper shoulders suggest a more substantial reversal, providing a stronger signal. Also, the pattern significance increases with the time it takes to form. So longer formation periods often correlate with more reliable reversals. And then just for stock trading, volume is crucial during the breakout. A surge in volume when the neckline is breached adds confirmation to the pattern's validity, indicating a strong buying interest. And finally, a particularly robust signal occurs when the price crosses above key moving averages while it's breaking the neckline, something like here, or is moving uh, is moving among the two moving averages, a short one and a long one. And the RSI, or relative strength index, moves above 50 following the neckline break. And this convergence of technical indicators strengthens the case for a bullish reversal. By understanding the inverse head and shoulders pattern, you can better position yourself to take advantage of market reversals. And you can capture the earliest stages of new uptrends. This pattern is particularly useful in volatile markets where significant downward movements are followed by sharp, let's say, recoveries. And here in this slide, let's focus on the continuation head and shoulders pattern. Okay, yeah, please don't be surprised. The head and shoulder is not only a reversal pattern. There are some scenarios in the market that we see head and shoulders pattern plays a role as a continuation pattern, which is a variation of the classic pattern. Unlike the standard head and shoulders, which signals a reversal, the continuation pattern suggests that the current trends will resume after a temporary consolidation period. Uh, let's say a continuation head and shoulders pattern typically occurs in the middle of an existing trend. Whether it's upward or downward, the pattern forms as the market takes a breather before continuing in the direction of the initial trend. In a sense, this pattern is a pause or a consolidation phase where the market tests the current trend before pushing forward again. Recognizing this pattern can be particularly useful for traders looking to capitalize on trend continuation rather than reversal. As with all head and shoulder patterns, the continuation pattern must begin with a clear and a strong trend. Please take a note of this. This is the first and the most important rule to identify uh, all chart patterns. In the example of this chart, you see we start with a downtrend, which sets the context for the continuation pattern to emerge. And this is going to be an inverse continuation head and shoulders pattern. And similar to the reversal pattern, this continuation pattern consists of a left shoulder. Here you can see a head, this one, and a right shoulder. However, the difference lies in what follows. Rather than reversing, the price action continues in the direction of the initial trend after completing the pattern. The neckline still plays a crucial role in this pattern. Let's say the most important rule here is on the neckline. The difference here is that once the price breaks the neckline, it signals the continuation of the trend rather than a reversal. In this example, the price breaks below, above the neckline after forming the right shoulder, indicating that the downtrend is set to resume because it couldn't manage to somehow break the neckline completely and clearly in a persistent manner. So in that case, we have this shooting star here somehow, or reverse hammer candlestick pattern, which is, is a bearish reversal pattern. So observe how the market is in a well-established downtrend before the pattern begins to form. And this strong initial movement is critical in validating the continuation pattern. You can clearly see the left shoulder followed by the head, which is lower, and then the right shoulder. The neckline is drawn across the low tops between these market bottoms, and as the pattern develops, the price tests this neckline multiple times. Okay, so we call it continuation head and shoulders pattern. And if you look at the chart, you might be able to find some good cases of this type of patterns, which they usually signal the continuing of the a prior trend. For example, let's zoom out a bit and take a look to see if we can find. I think we will be able to find something. Maybe in a gold's market. As you see here on the chart, the let's say head and shoulders pattern usually plays very important parts of all market turning points. You can find it everywhere. Okay, unfortunately, I couldn't find a good example here. So let's discuss this example on the let's say this slide here together again. So the ideal entry is after we see a reversal from the neckline that could give us a good trading opportunity in the direction of the prior trend. And then we can place our stop loss just let's say above the neckline here, and the good entry point will be where we see a nice break of the right shoulder. And for the take profit strategy, depending on your risk management rules, you can set always a conservative one as a 1-to-1 reward to risk ratio. Okay, thank you all for your attention and engagement throughout today's webinar in advanced head and shoulders patterns. We've covered a lots of ground from the basic identification and trading strategies to more complex variations and even the potential pitfalls of invalid patterns. Now, as we move into the Q&A section, this is your opportunity to deepen your understanding and clarify any questions you might have. Let me check. My colleague will check to see if we have any questions. And I guess we have some time to answer the questions. Yes, okay. Thank you. That's cool. Okay, here's the one question. How does the volume profile within the head and shoulders pattern influence the validity of the pattern and its subsequent breakout? It's a very good question. First, let me mention that the volume plays a significant role, but in stock trading, not in forex, because in forex we don't have a let's say actual real uh, volume, uh, but we have just a price ticks. Okay, so that's we assume it's representing the volume of the units traded in the market. However, the volume profile plays a crucial role in determining the validity and the strength of a head and shoulders pattern. Ideally, volume should increase during the formation of the left shoulder and the head, indicating a strong participation in the prevailing trend. However, as the pattern progresses, you should observe a decrease in volume during the formation of the right shoulder, signaling weakening momentum and a potential reversal. So the most important aspect of the volume profile is during the breakout of the neckline. A valid and a strong head and shoulders pattern is often confirmed by significant increase in volume as the price breaks the neckline. Because the surge in volume suggests that there is strong conviction among traders that the trend is reversing, adding weight to the breakout. So if the breakout occurs with low or declining volume, the signal may be weak and there is a higher likelihood of a false breakout or a quick reversal back into the original trend. I hope that could answer the question. Okay, what's the next one? Yeah, can head and shoulders patterns be effectively used in conjunction with Fibonacci retracement levels? If so, how do you integrate these tools to enhance your trading strategy? Very, very great question. Yes, Fibonacci retracement levels can be effectively used in conjunction with head and shoulders pattern to enhance trading strategies, of course. The Fibonacci retracement tool is commonly used to identify potential support and resistance levels. And we had a thorough, let's say, webinar about the Fibonacci level and how to incorporate it in our trading strategies. Uh, to integrate these tools, traders typically use Fibonacci retracement levels to identify potential areas where the left shoulder and right shoulder might form. For instance, after a strong uptrend, you might look for, let's say, for the left shoulder to form around the 38.2% or 50% Fibonacci level. Let's get back to for example, there are plenty of good examples of, let me just clean up my chart a bit. Yeah, there are many good examples of head and shoulders. I'm looking for one which is more simple and more obvious. By the way, doesn't matter. For example, let's take a look at this pattern here. So it's not a, there's a symmetry in this pattern. Yeah, we have a left shoulder, the head, and the right shoulder you see, and this is our neckline, and we have a very nice break through this neckline below the moving averages. And for example, one thing that you can use Fibonacci retracement level to identify potential areas where the left shoulder and right shoulder might form. For instance, after a strong uptrend, as you see here, we are in a very strong uptrend, and you might look for the left shoulder, but after spotting this, let's say, head, and you might want to see if the price gonna uh, form another lower top, the first lower top as the right shoulder. In that case, you can use the Fibonacci retracement somehow. For example, after seeing market topping here, and then you see the price just this rally also near to the 61.8% Fibonacci level. Or also another way you can use is after finding this the first market bottom here, which is included in the head and shoulders, and here is the, let's say, the left shoulder, and then you can again use your Fibonacci retracement to see where is the possible uh, place that the market is going to start forming the right shoulder. And you see this is the first retracement at this 61.8% Fibonacci level. And this is how you usually we use Fibonacci to spot uh, probable or potential points or levels, price levels that the shoulders going to be formed. Furthermore, when the neckline is broken, traders can use Fibonacci extensions to set profit targets. For example, the 161.8% Fibonacci extension level from the head to the neckline can provide a potential target for the downward move after a head and shoulders pattern completes. Or you can use it from the break point to the right shoulder here. And you can project the 200%, 161.8% as your price projection. Okay, so this combination of tools allows traders to have more precise entry, stop loss, and take profit levels, which can increase the overall effectiveness of our strategy. Okay, very well. I get to the end of this webinar. Thank you so much for participating in today's webinar. I hope you found the uh, discussion to take your trading to the next level. And thank you so much. I hope you have a very wonderful evening, and I hope to see you in our next webinar next week. Thank you. Take care. Have a good time.